EPK Capital presents Deep Dive on Adani Ports and Special Economic Zones. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host, Sneha. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Adani Ports and SEZ. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor. Today we're taking a deep dive into a company that is, quite literally, a cornerstone of India's trade and economic infrastructure, Adani Ports and Special Economic Zone, or APSEZ. This isn't just any company. APSEZ is a titan, handling nearly a quarter of India's entire cargo movement and dominating the private port market with a staggering 95% market share. In the last fiscal year alone, it managed a record-breaking 420 million tons of cargo. But here's the paradox. How can a company so vital to the nation's economy also find itself at the center of significant global controversy? In this video, we're going to provide a neutral, 360-degree analysis to help you understand both sides of this complex story. First, we'll break down the company's powerful business model and its incredible journey. Then, we'll dive deep into a decade of its financial performance. After that, we'll see what the stock charts are telling us and run a classic valuation test pioneered by the legendary Benjamin Graham. Finally, we'll weigh the pros and cons and tackle the tough questions in our important checks section before giving our final summary. Let's get started. The business and its promoters. To understand Adani Ports, you need to see it as more than just a port operator. Its real strength lies in a powerful, integrated business model that operates across three key verticals: ports and terminals, logistics, and special economic zones, SEZs. First, the ports and terminals. APSEZ has a vast network of 13 domestic ports spread across 7 maritime states, giving it an unparalleled national footprint. This includes crown jewels like Mundra Port in Gujarat, which is India's largest commercial port, Dhamra Port in Odisha, a strategic gateway to India's mineral belts, and Dahej Port, another key hub in Gujarat. The company is also expanding its international presence, most notably with its majority stake in the port of Haifa in Israel. Second, logistics. Through its subsidiary, Adani Logistics Ltd., the company complements its port operations perfectly. It runs logistics parks and even owns its own trains, creating a seamless, end-to-end solution that takes cargo from the ship, through the port, and deep into the country's hinterland. And third, the Special Economic Zones, or SEZs. The Mundra SEZ is a landmark example of this strategy. Spanning over 8,000 hectares, it integrates world-class port services with industrial infrastructure, offering a complete, ready-made ecosystem for businesses to set up shop. The company has even vertically integrated into dredging, operating the largest dredging fleet in India. This is a crucial capability for building and maintaining ports, giving them control over costs and project timelines. This integrated structure is designed to create a formidable competitive advantage. The company doesn't just unload ships, it offers rail transport, warehousing, and industrial land. This creates a sticky ecosystem. A business using Mundra Port is highly incentivized to use Adani's logistics and SEZ facilities due to the sheer convenience and cost savings. This increases the difficulty and cost for customers to switch to a competitor, granting APSEZ significant pricing power and a durable advantage over standalone port operators. The journey of growth, from Mundra to global player. The company's journey began in 1998, when it was incorporated as Gujarat Adani Port Limited. The initial vision belonged to founder Gautam Adani, who, inspired by the nearby Kandla port, set out to transform Mundra into a major economic gateway. The market quickly bought into this vision. The company's IPO in 2007 was a blockbuster, getting oversubscribed 116 times, which signaled massive investor confidence right from the early days. A key turning point came in 2012, when the company changed its name to Adani Ports and Special Economic Zone Ltd. This wasn't just a cosmetic change, it was a clear signal of its strategic shift towards becoming the integrated logistics player it is today. A defining feature of its history has been a relentless acquisition spree to build scale and consolidate market share. This includes the purchase of Dhamra Port in 2016, Krishnapatnam Port in 2020, Gangavaram Port in 2021, and Karaikal Port in 2023. This history reveals a clear growth-by-acquisition strategy. This approach has allowed APSEZ to rapidly expand its footprint and cement its market leadership, growing much faster than the industry average. However, this aggressive expansion is extremely capital-intensive and has been a primary driver of the company's significant debt load, a topic we will analyze in detail shortly. The Adani Group, promoters and shareholding. APSEZ is the flagship entity of the Adani Group, promoted by the Adani family and led by Chairman Gautam Adani, with his son Karan Adani serving as the managing director. Understanding who owns the company is crucial for any investor. The promoter group holds a very significant stake in the company. A high promoter holding is often seen as a sign of confidence. However, in the context of the controversies surrounding the group, it also raises questions about the true free float of the stock available for public trading, which is a central theme of the allegations we'll discuss later. At the same time, the significant stake held by large foreign and domestic institutions suggests that many sophisticated professional investors remain confident in the company's long-term prospects. 10-year financial analysis, decoding the numbers. Looking at a decade of financial data gives us a clear picture of the company's performance. The growth has been nothing short of spectacular. As the numbers show, revenue has grown from just over Rs 6,000 crores in 2015 to over Rs 26,000 crores in 2024, with net profit more than tripling in the same period. The company has delivered a stellar profit compound annual growth rate, or CAGR, of 23% over the last 5 years. What's equally impressive are the operating profit margins, or OPM. They have consistently remained in the high 50% to 60% range. This is a clear indicator of strong pricing power and remarkable operational efficiency. Now, let's talk about the debt. A business this capital-intensive, growing this aggressively through acquisitions, is bound to have a significant amount of debt. Total borrowings currently stand at around 51,454 crores. The key metric to watch here is the debt-to-equity ratio, which is currently about 0.79 or 79.2%. While this is high, what's crucial is the trend. Over the past 5 years, this ratio has actually reduced from 118.7%. This is a very positive sign, indicating that the company is actively working on deleveraging its balance sheet. Furthermore, the company's ability to service this debt appears strong. Its interest coverage ratio is a healthy 8.1 times, meaning its operating profit is more than 8 times its interest expenses. This significantly mitigates the risk of default. One point of caution is the company's liquidity position. Its short-term assets do not currently cover its short-term liabilities, which is something for investors to monitor going forward. The high absolute debt figure is often a key point in the bear case against the stock. However, when we look deeper, the narrative becomes more nuanced. The downward trend in the debt-to-equity ratio, combined with a strong interest coverage ratio, suggests that while the company uses significant debt to fuel its growth, its robust profitability and cash flows are allowing it to manage this leverage comfortably and even gradually reduce its risk profile. Finally, let's look at how efficiently the management is using capital. The company's return on equity, or ROE, is a very healthy 18.7%, and its return on capital employed, or ROCE, is 13.8%. An ROE of nearly 19% is excellent and shows that the management is generating strong profits from the money invested by shareholders. Stock chart technical analysis. From a long-term perspective, the APSEZ stock has been a massive wealth creator. The all-time chart shows a powerful uptrend, delivering a 5-year return of over 267% and an incredible all-time return of over 744%. This clearly establishes the long-term bullish character of the stock. However, zooming into the current, medium-term trend reveals a different picture. The stock has recently shown signs of weakness. It has broken below its rising trend channel and has formed what technical analysts call a double top formation. The recent breakdown below the key support level of Rs near 1338 signals the potential for a further fall. Currently, the key levels to watch are support at Rs 50 and resistance near Rs 1340. The stock's 52-week range has been between Rs 994 and Rs 1517.13. The price is also trading below its key short and medium-term moving averages, which is generally considered a bearish signal. Looking at momentum indicators, the Relative Strength Index, or RSI, is currently below 30. This indicates that the stock is in oversold territory. This presents a classic technical dilemma. An oversold RSI can mean that the selling has been overdone and the stock is due for a rebound. However, it can also signal strong negative momentum and that the price may continue to fall. Other indicators like the MACD are also flashing bearish signals. Here's where it gets interesting. Despite these bearish short-term technical signals, the consensus among financial analysts who cover the stock is overwhelmingly bullish. The average price target is around Rs 17.17, which suggests a potential upside of over 30% from current levels, with some of the highest estimates reaching 1900. This creates a significant divergence. The technical charts are pointing to short-term weakness, while the fundamental analysis from brokerages is pointing to long-term strength. This suggests the market may be reacting to short-term headwinds or negative sentiment, while analysts believe the long-term business story remains firmly intact. For an investor, this highlights the importance of your investment horizon. A short-term trader might see a reason to be cautious, while a long-term investor might see this dip as a potential buying opportunity. Benjamin Graham, Valuation: Finding the Intrinsic Value. Now, let's try to determine the stock's intrinsic value using a time-tested formula from the father of value investing himself, Benjamin Graham. Graham, who was Warren Buffett's mentor, proposed a simple formula to calculate the intrinsic value of a stock for a defensive investor. It's designed to be conservative and provide a margin of safety, which gives us an intrinsic value of approximately Rs 582. Comparing this calculated intrinsic value of around Rs 582 to the current market price of roughly Rs 1300, the conclusion from this specific metric is clear. The stock appears significantly overvalued. However, this result comes with a major caveat. The Graham number is a classic value investing tool, heavily anchored to a company's current book value. It's best suited for stable, predictable companies. Adani Ports, on the other hand, is a high-growth infrastructure company. Its value is derived not just from its current assets, but from its future earning potential, its strategic dominance, and its irreplaceable network of ports, factors not fully captured by book value. The stock's price-to-book ratio of around 4.5 is far above Graham's 1.5 limit. Therefore, while the Graham number provides a crucial data point for a conservative value investor, a growth-focused investor would argue that it's not the most appropriate metric for a company like this. It highlights the fundamental difference between value and growth investing philosophies. Pros versus cons: the bull and bear debate. Unmatched market leadership. The company is India's largest private port operator with a massive and growing share of the country's cargo. This scale creates a deep competitive moat that is very difficult for others to challenge. Integrated business model: the powerful synergy between its ports, logistics, and SEZ verticals creates a sticky ecosystem for customers with high barriers to entry. Strong growth and profitability: the company has a proven decade-long track record of robust growth in both revenue and profits, combined with consistently high and stable operating margins. Strategic national importance: APSEZ is a direct proxy for the India growth story. As India's international trade grows, APSEZ is poised to be a primary beneficiary. Strong analyst backing: the overwhelming majority of market analysts who cover the stock have a buy or strong buy rating, seeing significant upside potential from current levels. Significant debt burden. The company operates with a high level of debt on its balance sheet, a direct result of its capital-intensive business model and its aggressive acquisition-led growth strategy. Corporate governance overhang. This is arguably the biggest risk. The entire Adani Group faces serious and unresolved allegations of stock manipulation, accounting fraud, and improper use of offshore entities, as detailed in the Hindenburg Research Report. Premium valuation. The stock trades at a high price-to-book ratio of over 4.5, making it appear expensive on traditional valuation metrics, as our Graham number calculation showed. Regulatory and geopolitical risks. The business is inherently vulnerable to slowdowns in global trade, geopolitical conflicts that disrupt shipping routes, and changes in government policies and regulations. Important checks, due diligence for investors. Before investing in any company, and especially one like this, there are a few critical checks every investor must perform. First, and most importantly, are the allegations from the Hindenburg Research Report. In January 2023, the US-based short seller published a report alleging brazen stock manipulation and accounting fraud across the Adani Group. The key allegations relevant to investors include stock parking. The report alleged that the group used a complex web of offshore shell entities, primarily managed by Gautam Adani's brother Vinod Adani, to hold large, undisclosed stakes in its own listed companies. This was allegedly done to bypass Indian securities law, which requires a minimum of 25% public shareholding. Suspicious related party transactions. It also alleged that money was funneled between the group's publicly listed companies and private entities controlled by the Adani family to manipulate earnings and present a healthier financial picture than reality. Precarious financial footing. The report highlighted the high debt levels across the group, with shares of the listed companies often pledged as collateral for loans, creating systemic risk. It is crucial to state that the Adani Group has vehemently denied all of these allegations, calling the report a malicious combination of selective misinformation and stale, baseless, and discredited allegations. India's market regulator, SEBI, has been investigating the matter, but the issue remains an unresolved risk for investors. Another key risk to check is promoter share pledging. This is when promoters use their shares as collateral to take loans. It's a risk because a sharp fall in the stock price can trigger a margin call, forcing the promoter to sell shares, which can cause the price to fall even further. According to the latest data, a small portion of the promoter holding, about 1.34% of the SB Adani Family Trust's stake, is pledged. While this is a relatively low and manageable number right now, it is a critical metric that investors must monitor continuously. Finally, the Hindenburg report raised concerns about the quality of auditors for some Adani Group companies, pointing to a very small and relatively unknown firm that was auditing massive corporations like Adani Enterprises and Adani Total Gas. While Apsez itself is audited by a larger, more reputable firm, these concerns have contributed to the overall cloud of questions surrounding the group's corporate governance practices. Conclusion: the final verdict. So, after this deep dive, where do we stand on Adani Ports? The analysis presents two very different, almost conflicting stories. On one hand, we have a phenomenal business. Adani Ports is a dominant market leader with a powerful, integrated business model that gives it a wide competitive moat. It has demonstrated incredible growth, high profitability, and is a world-class infrastructure asset that is central to India's future. On the other hand, we have a significant list of risks. The valuation appears rich on conservative metrics, the debt level is high, and most importantly, there are serious, unresolved allegations regarding corporate governance that cast a long shadow over the entire group. So, is Adani Ports a buy? The answer depends entirely on you, the investor, and your personal risk appetite. If you are a growth investor who believes in the long-term India infrastructure story, and you are willing to accept the premium valuation and the corporate governance risks in exchange for the potential of high returns, the bull case is undeniably compelling. However, if you are a conservative or value-oriented investor for whom strong corporate governance and a margin of safety are non-negotiable, the red flags raised are likely too significant to ignore. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.